It does take us to our talk of the tape, whether the bull market is at serious risk or not. Let's ask Dan Greenhaus, Chief Strategist for Solus Alternative Asset Management, with me here at Post 9. Welcome back.
Thank you, sir.
You see the Barron's over the weekend, Dow 40,000, so close you can feel it. Why you should fear it. And they make a direct line to the CPI because that's coming up on Wednesday. PPI is tomorrow. They say recent history points to reasons for pessimism. At this rate, investors could be betting on rate hikes instead of cuts before the fall. What do you make of that?
I mean, that's, first of all, until this moment, I had no idea where the Dow is. So thank you to Barron's.
39,444.
I see it's on the wall now.
Glad you're paying attention.
Well, but listen, I think there's a lot to worry about in the short term here. The market, the S&P 500 is basically at a high, and call it only a third of the index is within a couple of percent of its 52-week high. So it's a little bit of a narrow breath here. Obviously, the Russell hasn't rallied. So there are some things that you would like to see happening that aren't happening. But on balance, I think you have to be pleased with how the market's holding up here, especially with yields coming back in.
Well, I mean, the market's rallied back pretty sharply over the last month. The Russell's up 3.2%. That's not insignificant. I mean, the broadening trade has obviously worked, right? The Russell and the Dow are the best over the last month by a fair amount.
Yeah,
twice as good as the other.
I mean, just to reiterate a point that we've talked about on air repeatedly, I don't think that you need to look, in terms of the broadening out, I don't think you need to look at the Russell 2000 as evidence for it. First of all, lost in the conversation about the Russell lagging in a longer-term trend is that mid-caps are basically at a high as well, and those are companies that people are much more familiar with as compared to the S&P 500.
Okay.
And then within the S&P 500, first of all, within the Mag 7, you have a bit of a rotation here.
Sure.
But within the S&P 500, you see, I don't think people realize, and it's just starting to get some attention now, the second best performing sector year to date is utilities.
Okay.
Now, obviously, that's part of the AI derivative trade that I think I've been harping on air for.
It's by far the best performing sector over the last month.
That's right.
I mean, it's not even close.
Yes.
It's a double-digit percentage gainer.
Yeah, if we throw up I see we have a chart of the XLU up. If you zoom in on that, I mean, that's a parabolic move,
well,
so to speak.
People now are like making it the next AI trade.
Well, first of all, and again, just to reiterate my point on air, whenever we talk about NVIDIA, for instance, my point has been that there are AI derivative trades that you can play that aren't particularly the semiconductors. And I'm not saying that I secretly meant you should buy the utilities the entire time, although I'm not going to say that I wasn't saying that it's utilities.
Right, there's no evidence to suggest one way or the other.
That's right.
So you'll live in the gray area.
That's my kind of evidence, Scott. But yeah, I mean, there are other plays at work here to play the AI trade. Right now, utilities are getting some attention. There are others, and some of these names are up 80, 90, 100% year to date, rivaling some of the Mag 7 and more traditional AI plays.
Let's talk about this. If you look at the activity in the market, let's just call it what the Wall Street Journal sort of characterizes it as today. Investors have been piling into the soft landing trade.
Yeah.
Because that's what it is. That's why all of these other sectors, you could take utilities out of that. It's not necessarily a soft landing trade, unless the derivative of rates coming down, the boil coming off rates, plays a role in that particular trade. But you know what I mean.
Sure.
Financials, industrials, materials, people talking positively about China again. And it's all sort of plays into that story. Is it misguided?
No, I don't think so, because all the evidence has been and remains that, for lack of a better word, a soft landing, and again, we have to have a conversation about what we mean by that, but at least for now, the hard landing, the recession that everybody thought would occur, is not. I think that the problem that we have right now is, for someone like myself who thought there was going to be a recession, call it a year and change ago, but gave that up a year and change ago, there's still people holding out this idea that, well, it's going to happen, just give it time. And maybe that will be the case. But in the meantime, the stock market keeps racing, not quite to new highs, but on its way to new highs, while you're still out there clamoring for a recession that no data point right now, at least, seems to suggest is forthcoming.
So then we should stay with the broadening trade?
I think so. I mean, listen, you see this, again, not just from large to small or whatever. You see it within the market. You mentioned financials, traditional cyclicals. Energy is one of the best performing sectors year to date, something that we've talked about for quite some time. There are plenty of ways to make money in this market that are not just 7 stocks, and that's been the case for, 18 months.